Today, the mechanics of housing are broken. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and property news with a distinctively Australian flavour. Today, I want to look at a range of recent data to highlight just how broken our housing market is. Now, I regularly talk about how high prices are relative to income and how households are under financial pressure, but there are other forces to consider too. For example, we got updated data from the RBA yesterday on indicative mortgage lending rates. And despite the ongoing debate about if and when the RBA might lift the cash rates, the mortgage is already reacting with higher mortgage rates. Note that these are indicative rates, but the trend is clear. Across the fixed loans, both shorter term and longer term fixed loan rates have risen. For example, loans more than 3 years in duration were available at just 1.99% just a year ago, but by the end of January, they'd risen to 3.07%. And it's also worth noting that high LVR loans are priced at higher rates, although the standard variable rate has moved down to 2.52% as the banks transfer interest rate risks to consumers. The RBA's average mortgage rate data, released last week, showed that there was a sharp 1.38% rise in 3-year fixed mortgage rates from 2.1% in February 2021 to 3.48% in February 2022, whereas variable mortgage rates remain steady at 3.45%. And comparison site Mozo has recorded similar large rises in fixed mortgage rates from their databases. A 1-year fixed mortgage rate has risen from a low of 2.27% in November 2021 to 2.59% currently. That's an increase of 14%. A 2-year fixed mortgage rate has risen from a low of 2.22% in September 2021 to 2.87% currently. That's an increase of 29%. A 3-year fixed mortgage rate has risen from a low of 2.32% in July 2021 to 3.28% currently. That's an increase of 41%. A 4-year fixed mortgage rate has risen from a low of 2.37% in March 2021 to 3.69% currently. That's an increase of 56%. And a 5-year fixed mortgage rate has risen from a low of 2.62% in March 2021 to 3.8% currently. That's an increase of 45%. But Mozo said, in stark contrast, having been steadily decreasing for some time now, the average variable rate sits at 3.05%, and that's down 23 basis points in the past 12 months. And while that trend looks to set to continue, it can all change at a moment's notice when the RBA decides to raise the cash rate. When that happens, lenders won't hesitate to pass on the extra costs onto their customers. So, if you've been tempted by one of the many low variable rates out there, keep in mind that your monthly repayments could look a whole lot different in a few months' time. Once the RBA begins lifting the cash rate, variable mortgage rates will also rise, and this will inevitably drive Australian property values lower. So there is a nasty pincer movement here. And here's another one relating to high listings and auction volumes, which have driven auction clearance rates lower. CoreLogic said that with 2,945 homes taken to auction this last week, the preliminary national auction clearance rate came in at 72.7%. That's down from 74.3% last weekend. There were 2,945 homes taken to auction across the combined capital cities this week, down from 3,386 over the previous week, while significantly higher than this time last year when it was 1,569. Of the 2,339 results collected so far, 72.7% were successful, down from the previous week's preliminary clearance rate of 74.3%, while revised down to 70.9% in final figures. This time last year, 80% of reported auctions were successful. Despite the recent weather and flooding events in Brisbane and Sydney, auction withdrawal rates have held relatively low. 16% of auctions were withdrawn across Sydney last week, compared with the year-to-date average of 12%, while in Brisbane 18% of auctions were withdrawn, year-to-date average of 11%, compared to a year-to-date average of 11%. Melbourne was the host of 1,426 auctions this week, down from 1,574 over the previous week, and 487 this time last year. And of the 1,159 results collected so far, 70.4% have been successful, down from the previous week's preliminary clearance rate of 71%, which revised down to 67.6% in the final figures. And over the same time last year, 75.2% of reported auctions were successful. In Sydney, 993 homes were taken to auction across the city, down from 1,202 from the previous week and 789 this time last year. The clearance rate was down week on week, with 74.6% of the 808 results collected so far reporting a successful result. And the previous week saw a preliminary clearance rate of 76.9%, which was revised down subsequently to 72.6% at final figures, while this time last year, 82.9% of reported auctions were successful. And across the smaller capitals, Adelaide recorded the highest preliminary auction clearance rate at 82.1%, followed by Canberra at 75.7% and Brisbane at 69.8%. And in Perth, one of the three results collected so far was successful. And in terms of auction volumes, Adelaide was the busiest auction market this week, with 194 homes taken to auction across the city, followed by Brisbane at 180, Canberra at 140 and Perth at 10. There were only 2 auctions in Tasmania this week, and one of them was successful. Now, as I've explained before, calculating clearance rates is more an art than a science, depending on your definitions and geographic coverage, so I tend not to read too much into them. In fact, the trajectory of listings, as I discussed with Edwin yesterday in our rant, is a better guide, but the media love reporting the auction clearance results nevertheless. Now, here's another issue to think about. Domain has released its rental vacancy report for February, which shows that the national vacancy rate has fallen to its lowest level on record, 1.1%, following the reopening of the international borders. Vacancy rates remain tight, and the landlords' markets in all capitals, apart from Melbourne. In fact, Canberra, Brisbane, Adelaide, Perth and Hobart have vacancy rates at their lowest point since Domain records began in 2017, while Sydney is at the lowest since November 2017 and Darwin is close to a multi-year low. Adelaide and Hobart are the most competitive capital city rental markets, with vacancy rates extremely low at 0.3 and 0.2% respectively, creating a rental crisis and making it impossible for prospective tenants to find a lease. Sydney is well below pre-COVID levels and the lowest it's been since November 2017 at 1.7%. Melbourne is sharply recovering from the pandemic-induced spike, reaching the lowest vacancy rate since March 2020. And given that Sydney and Melbourne have historically welcomed more overseas migrants, as well as being popular tourist destinations, demand for rentals will continue to spiral. This will also be the case for Australia's other typical tourist hotspots. In Canberra, for the second consecutive month, there was a fall in the vacancy rates in February after 2 months of rising rates. Available rentals dropped 27.2% compared to last month. So this has led Domain to warn that Australia is on the verge of a rental crisis, as rental demand will continue to sharply rebound following the full reopening of international borders to double vaccinated visa holders and tourists following 2 years of closures. And Domain also believes that rental pressures will hit hardest in Sydney and Melbourne, which typically receive the lion's share of migrants. Rental stock continues to trend lower across all capital cities, consistent with increasing demand seen in January, absorbing availability. And stock is also lower in all the capital cities annually and at its lowest level since Domain records began nationally and in Canberra, Brisbane and Adelaide. While investment activity is rising, the opening of international borders will spiral rental demand since most overseas migrants rent upon arrival. So the rental market is already tightening significantly in the face of flat population growth due to the pandemic-induced reduction in average household size, for example, because people want more space. And now the international borders have reopened to immigration, with the Morrison government wanting to at least bring in 200,000 migrant workers to arrive in Australia by July 2022. So the inevitable outcome will be tightening vacancy rates and rising rents, which will hit the poor the hardest. But there is still the fact that many high-rise investors continue to lose money and are trying to sell. So the supply-demand issues are yet to play out. But in our surveys, some renters are now having to pay up to 70% of their income to keep a roof over their head. So the rental market is well and truly broken. And talking of broken, something else to bear in mind is that the average lot size has been shrinking significantly. For example, new data on greenfield land sales across Greater Melbourne showed that lot sizes are shrinking and median prices are rising amid land shortages and rising construction costs. In Melbourne, the country's biggest residential land market, lot sales reached 21,000 in 2021, while prices increased 15% as first home buyers and others priced out of the established housing market headed for the outer suburbs. This year, we expect to see more developers begin to drip feed vacant land releases to give them time to catch up on construction and lower long-term risk factors, said Luke Kelly, Managing Director for Project Marketing at RPM Real Estate Group. RPM recorded a 6.4% rise in the median Melbourne lot price in the December 21 quarter, taking it to an all-time high of $347,000. Another land sales specialist, Red 23, said the median price of a new Melbourne home has risen above $700,000 in January, after it recorded a median lot price of $376,000 and an average building cost of $327,000 and rising. So we're talking here about shrinkflation, which is a structural trend that will continue as the federal government reboots the big Australia mass immigration program. The latest intergenerational report projects that net overseas migration will increase to an average of 235,000 people a year. This extreme immigration this extreme immigration will increase Australia's population by 13.1 million people, or 50%, over the next 40 years to 38.8 million people. That's equivalent to adding another Sydney, Melbourne and Brisbane to Australia's existing population. Now, such a population flood will necessarily bulldoze our suburbs into higher density, as well as shrink the outer suburban lot sizes. So expect more crowded subdivisions. And when you buy property, you'll be buying less for more. Yet another hidden factor which many perhaps will fail to consider. So if you stand back and think about all these things, rising interest rates, land supply, rentals, and clearance rates, you can see that the mechanics of the housing market is fundamentally broken. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.